Hello everyone, this is the quiz review video for your quiz on cash events, which is Chapter 8 in Pearson. The first issue we're going to tackle are credit and debit card sales. So when you are a retailer and your customer makes a purchase using a credit or a debit card, the company that issued that card, be it Visa, MasterCard, Berkshire, Amerique, whatever company is issuing the card, is going to charge you a processing fee. That's how those companies make money in the first place. We'll add on top of all the interest they charge us. But the processing fee is normal in the business world. Let's take, for example, Ollie's Ornaments. Well, Ollie's Ornaments had the following during April 20XX. They had $84,000 in credit card sales and $80,000 in debit card sales. They have to pay a 4% processing fee on all debit and credit card transactions. So those numbers over there are raw sales, but Ollie's Ornaments is going to have to pay 4% of each one of those numbers to the respective companies that issued these cards to our customers. Well, there's two ways we can account for that processing fee. We can use the gross method or the net method. And in the gross method, what we're going to do is we're going to record our sales at full price, so not concerning ourselves with this processing fee. And then later, when that lending institution, issuing institution I should say, charges us those processing fees, we'll account for it. We'll record the expense for the processing fees. The alternative method, and the method that's much more commonly used, is the net method. In the net method, you subtract the amount of the processing fee out of the cash that you're receiving at the time that you're making the sale. So you record sales revenue for the full amount, but you only record the cash that you're going to receive for that sales price minus the expense that you're going to have related to this processing fee. In the journal entries for this, let's start with the credit card sales. And Ollie's Ornaments had $84,000 in credit card sales. For the net method, when we record this at the end of April, on April 30th, we're going to record cash, but we're going to record cash net of the credit card expense that we are going to have to pay. Well, how much cash are we going to get? It's easy enough to find. It's $84,000 in credit card sales, but we know that we got to pay 4% of that in processing fees to the card companies, which means we're only going to get 96%, if you will. So if we use this formula right here, we figure out that 96% of $84,000, Ollie's Ornaments is getting $80,640. The portion that is going for that processing fee is going to get recorded under credit card expense. And again, it is for the amount of sales revenue you did times the percentage that you are getting charged for that processing fee on the card. In this case, it's $3,360. However, when we add both of those debits up, they come up to $84,000. So we still record our sales revenue at its full amount, the face value of the sale, not considering the processing fee. And we recorded net credit sales for April. If you were, however, to use the gross method, we wouldn't worry about the credit card expense at the time that we're making the sale. So we would record cash in full for $84,000 and sales revenue in full for $84,000 to record our gross credit sales for April. But what happens to the credit card expense? Later, when we get billed by the credit card company, we would take that money out of cash and we would put it into credit card expense. So essentially, using the gross method, you're going to end up at the same number. It just requires you to have two separate entries, which is why companies prefer to use the net method, because it requires less bookkeeping. You already have it there. Sure, you might underreport your cash every once in a while because you haven't actually paid the credit card expenses yet, but all things considered here, it's a small amount in the scheme of things of your business, so it just makes it easier on you to record net. Let's do this for the debit card sales. They had $80,000 in debit card sales. They pay a 4% processing fee on debit card transactions as well. This won't always be true. Sometimes the percentages are different between debit and credit card sales, but in this example, they happen to be the same. So on April 30th, we got to figure out how much cash they're getting. Well, they did $80,000 in debit card sales, and they got hit with a 4% processing fee. So they're getting 96% of that $80,000, which means Ollie's Ornaments is going to receive $76,800. They're going to have to record their credit card expense, which is always going to be equal to the amount of this type of sales they did, in this case debit card sales, times the processing fee percentage, which was 4%. So times the $80,000 in debit card sales is $3,200, but they'd still record sales revenue in full for $80,000. This is to record their net credit sales for April. Under the gross method, again, we don't worry ourselves with the credit card expense until we actually have to pay it. So to record it this way would just be cash of $80,000 over sales revenue of $80,000 to record our gross credit sales for April. Another cash related issue is petty cash funds. And petty cash funds are basically lock boxes full of cash sitting around the office where employees can take out small amounts if they need something significant but inexpensive to the business. So things like printer ink, things like paying postage, maybe a delivery shows up that you have to pay for on delivery, COD, cash on delivery. If those things happen, they typically come out of petty cash. So most companies have a petty cash fund, and that petty cash fund will have a balance that it starts each month with, and that balance in accounting terminology is called the impressed balance. So we have Wingtips Plain Cleaning, who is establishing their petty cash fund on January 1st. The impressed balance of this fund is going to be $320. That means at the beginning of every single month, Wingtips Plain is going to replenish this petty cash box back up to that same balance of $320, unless they decide to change the impressed balance. But for now, it's going to be $320. So how do we establish the fund? Well, we have to create a separate asset account called petty cash. So petty cash is going to get debited for $320, and we're going to take the cash to put into petty cash out of our general cash fund, our bank account, which means cash is going to decrease by that same $320. And what happened here is we created the petty cash fund. So throughout the month of January, our employees are going to use this petty cash fund. And when they do, they're going to leave tickets in there. So there's usually a piece of paper that is with the lockbox. You have to fill out the information on how much you spent, on what date you spent it, and what you spent it for. What we have here are tickets for Wingtips during the month. They had a ticket number 1, that was for supply deliveries in the amount of $30. Ticket number 2 is for postage for $10. Ticket number 3 was for flyer printing for $35. Ticket number 4 was for key replacements. They lost the key and they had to get a new copy of it. That was $50. And then ticket number 5 was their purchase of printer paper for $80. So these are the 5 reasons that employees took money out of petty cash. And at the end of the month, at the end of January, there was still $105 in the petty cash box. That was the remaining balance. Well, we can replenish the fund and record all of the expense for the things that came out of petty cash in one journal entry. What we want to start with is our debits. And our debits are the amount of the tickets and what they were for. So supply deliveries was for $30. Well, let's call that delivery expense and debit it for $30. Postage was for $10. We'll call that postage expense. And we're going to debit that for $10. Flyer printing expense. I've also seen this thrown under advertising expense, but Pearson likes the word printing expense. Whatever. That's for $35. And then we got key replacement. And that's not an account that companies would normally have, key replacement expense. I mean, how often are you really losing keys? So if you have something that's infrequent like that, but you still have to pay for it and put it on your books, you just throw it into this catch-all account of weird, irregular payments that you would have to make called miscellaneous expense. So we're going to put that key replacement in miscellaneous expense for $50. And in the purchase of printer paper, well, what is that to us? Printer paper. It's something we're going to use in our normal course of actions to help us make money, but we're not selling it to our customers, which means it gets recorded under supplies. And that was for $80. And then after you've made a debit for every one of your petty cash tickets, you want to skip a line, and we'll get to that reason in a second. But after you've skipped your line, you always want to credit cash to show how much cash is missing from the petty cash box. Well, what was our beginning balance for the month? It was $320. How much cash is remaining at the end of the month? It's $105, which means our petty cash fund is missing $215. So we're going to have to take $215 out of our bank account to put back into the petty cash fund to restore it to its impressed balance of $320. Why did I have you skip a line? Well, here's the catch. If we add up all of our tickets, we've got 30 for delivery, 10 for postage, 35 for printing expense, 50 for miscellaneous expense, and 80 for supplies. That only adds up to $205. So even though there's $215 missing from the box, we only have $205 of it accounted for. So what happened here? A ton of things could have happened. Somebody bought something for a good reason and just forgot to fill out a ticket. It happens. Maybe somebody wrote the wrong number on the ticket. Maybe the purchase of printer paper was really $90 and they wrote 80 on accident. That could happen. Those are good, honest mistakes. Another dishonest mistake that could be in there is somebody just stole $10 from the petty cash box to go buy Burger King. But for whatever reason, there's $10 more missing from our petty cash box than what has been accounted for. So what do? We got to have another debit for 10, and we're going to put it in an account called cash short and over. And this is the expense account that we use for money missing out of petty cash or pretty much on ground fund that our company has. If something comes up missing, we don't have a reason for it, it goes into this cash short and over expense. And now that we have $215 on both the debit and the credit side, we can write in our description, which is we replenish petty cash to its impressed balance. So you may have noticed in the prior entry that petty cash, the account itself, wasn't part of the entry to replenish its balance. It's true. When you put petty cash on your books, you essentially just leave it there the whole time at its impressed balance, and you just take the amounts restored out of regular cash at the end of each period. You could, if you wanted to, take it out of petty cash, but then you would have to take the money out of cash and put it back into petty cash again. So you're really just causing yourself to do another entry. That's confusing. Don't worry about it. Just know that the only times that you're ever going to actually use the petty cash account in a journal entry is when you're either establishing the account for the first time, or you're changing the impressed balance of your petty cash fund, which is what's happening to Wingtip Planes on February 1st. They want to change the balance of petty cash to $500. So they're going to starting each month with $500 in the petty cash box instead of the $320 that they had. Well, now we're going to need a debit to petty cash to increase the amount that we carry in our box at the beginning of the period. The new balance we want to have is $500. Our old impressed balance was $320, which means we are increasing by $180. So we're going to debit petty cash for that amount, and we are going to credit cash for that same amount, $180. And we increased the impressed balance of the petty cash fund. If for whatever reason somebody decided to decrease the balance of the petty cash fund, what would the journal entry be? It would be this journal entry, just upside down. Debit to cash, credit to petty cash, because now you'd be taking it out of petty cash and putting it back in your regular bank account. And now on to the big thing from Chapter 8, which is bank reconciliations. So at the end of every month, the bank is going to send you a bank statement. I know you can go online and look, but they're still going to be required to send you an actual statement at the end of every period. And that number on your bank statement that says how much cash you have is pretty much always going to be different from what your cash account T or your cash T account's balance says. Why is that? Because there's things that the bank is going to know about that we don't know about yet. And then there's going to be things that we know about that the bank hasn't taken into account yet. So what we have to do is a reconciliation. Essentially, we have to go and we have to look at the bank statement we received, as well as what our, in this case, checkbook register is saying what our payments were for and what we increased our checking account by during the period to find discrepancies. So now that we have our bank statement and our checkbook register, we need to note the differences between the two statements. Let's start with our cash receipts on our checkbook register and our deposits in the bank, right? If we receive cash, we should eventually have deposited it in the bank, so these numbers should line up. Are there any things that are appearing on one statement that aren't appearing on the other? And the first one, right off the get-go, on December 1st on our bank statement, it says EFT 150. EFT is an electronic fund transfer. In our case, since it's a deposit in our bank, it's a receipt for us. Somebody paid us via electronic fund transfer and never notified us. So we never put the cash on our books in a journal entry, but it's been sitting in the bank. So what amount was it for? 150. What's the next things that we have? Well, on December 4th on our checkbook register, we recorded a receipt of $4,140 that we were depositing in the bank, and the bank recognized it the next day on December 5th. The same is true on December 9th. We had a $470 receipt, and we deposited it in the bank. It showed up the next day. Same for that $560 receipt, also showed up the next day. And on December 17th, when we received $2,400, it showed up in our bank statement the next day on December 18th. There's that $2,400. Then we got some issues on the bank statement. On December 22nd, we have BC 1200. What is that? BC stands for bank collection. So the bank collected something on our behalf, and whatever it was, and we'll find out soon, was for $1,200. So that's a discrepancy that we have to record. Also, on our checkbook register, we have a receipt that we're recording on December 31st, which is not showing up on the bank statement. What that means is we took this money, and we, after we collected it, deposited it in the bank. But it's not showing up on the bank statement yet. Why? Well, we deposited on December 31st. Maybe it's possible they prepared their end of the month statement before they recognized this deposit. So this is a deposit that we know is there. It's not actually showing up yet, and we call that a deposit in transit. And we're going to record this deposit in transit for 1810 at some point. So let's file that under discrepancies. And now all of our numbers line up. Everything that was either on our cash receipts of our checkbook register or the deposits in our bank statement, we've accounted for everything. We found our 3 discrepancies. All of the other numbers match up. We're good on that side. So let's move on to the cash payments section of our checkbook register, as well as the checks coming out of our bank statement. Well, what do we have first? Starting on the bank statement, right off the get-go, on December 8th, it says NSF 900. What is that? That is a non-sufficient fund check. Essentially, somebody paid us at some point. We thought the check was good, so we put the cash onto our books when they paid us, and then we deposited the check in the bank. And it turns out that check bounced. So we don't actually have that cash because whoever was paying us didn't have enough cash to make that check good. So we have to note that discrepancy. So we're going to have an NSF check discrepancy for 900. Next thing we have down on the bank statement is December 11th. We got check number 1416. Well, we had that in our checkbook register. That one is good. On December 19th, we have EFT of $840. Since this is a check coming out of our bank account, it's a payment that we're making to someone. So probably an automatic payment that we made to someone that we owed money. But regardless, $840 came out of our bank account, which we never accounted for on our books. So that EFT payment of $840 is a discrepancy. We have check number 1417 for $150 on our cash payments of our checkbook register, and it's showing up on our bank statement. We have check number 1418 for $700, which is also showing up on our bank statement for $700. And then we have check 1419, which the check number is showing up on our bank statement. But there's a problem here. See, on our checkbook register, it says it was for $690, but our bank statement is saying that it was for $960. So we got an issue here with check number 1419. What probably happened? Whoever was recording this journal entry transposed numbers. They meant to write 960, but they wrote 690 on accident. But still, the bank is showing 960. When in doubt about an error on an amount on a check, always assume that the bank is right, because the bank's not going to change their numbers to what you think it should be unless you prove it first. So always assume that the bank is correct if you have mismatched totals, and record it as a book error. So we have an error on check 1419, which we are assuming should have been for $960, which means we underreported it by $270. Next up, on December 31st, we have 3 items on our checkbook register which are not showing up on the bank statement. They are check 1420, 1421, and 1422. So why are they not showing up in the bank statement? Well, what probably happened is we wrote them, and whoever we paid them to hasn't cashed them yet, or they have cashed them and it hasn't cleared the bank yet. But regardless, we wrote the checks. We know the checks are good, but they haven't come out of the bank yet by the time the statement was prepared. And that is an outstanding check. So we're going to record all 3 of those outstanding checks for the amount listed on our checkbook register. And we have one more discrepancy, and it's on December 31st. On our bank statement, it says SC, that is a service charge, and your bank hits you with it every single month. So at the end of the month, we got a discrepancy for our service charge. And now all of our numbers are accounted for our payments coming out of our bank as well. So let's prepare our bank reconciliation. The first thing you need to do is go to your bank statement and figure out what is the bank saying was your balance at the end of the month. And for our bank statement, it's telling us that our ending balance was $19,055. Next, we're going to go to our checkbook register, which has the book balance. You could also go to your cash T account. We'll tell you that as well. That balance is $18,310. So now that we have our beginning balances and we realize that they're off by a little bit, let's prepare this bank reconciliation so we can get what the bank's saying we have and what we're saying we have to line up. Let's start on the bank side. And on the bank side, there are a couple of golden rules, because you can't mess with the bank's books because it's the bank, it's not your company. There are very little things you're allowed to do on the bank side of a reconciliation. Under the add section, the only thing you can do is record any deposits you know you made into the bank that haven't shown up yet. So let's record our deposit in transit. That deposit in transit was for $1,810, and since we know we're putting the money in the bank, it's going to increase our bank balance. So if we add those two together, we get a subtotal of $20,865. For the last section on the bank portion of your bank reconciliation, the only thing that you are allowed to reduce the bank balance by is any number of outstanding checks that you have. Well, we had 3 of those guys. So in total, those 3 outstanding checks that we had are going to total up $3,240. So the bank is saying we have $19,055, but after they add in the $1,810 deposit that we made that we know about, which is not showing up, and they subtract out the $3,240 of checks that we know we wrote but they haven't taken out yet, our bank balance should be $17,625. Let's go through and cross off everything we used. We used the deposit in transit as well as all of the outstanding checks. We get to move over to our book side. We have the add side and the less side. So the add side is going to contain everything that the bank knew about that we didn't know about yet, which is going to increase our cash balance. So an EFT receipt sure sounds like it's going to increase our cash balance. So let's put that in for $150. A bank collection on our behalf is going to increase our cash balance. So let's put that in for $1,200. And in total, we got $1,350 worth of things that the bank knew about, which is going to increase our cash balance that we have not accounted for on our books yet, bringing us to a subtotal of $19,660. And let's cross those off and see what we got left. We have an NSF check, we have an EFT payment, we have that book error that we made, and we have the service charge. Well, all these things are going to decrease the amount of cash that we have. So in the less section, let's fill them all in. On our books, after we account for the adds that we had and the total of $2,035 worth of subtractions from our cash account, our number should reconcile with our adjusted bank balance. So let's see what we got here. We started with a book balance of $18,310. We added $1,350 worth of things that the bank knew about that we didn't to come to a subtotal of $19,660. Then we subtracted out $2,035 worth of expenses that the bank knew about that we didn't know about yet, meaning that after we account for all of this, our book balance should be $17,625. And now we breathe a huge sigh of relief, because guess what? Our adjusted bank balance and our adjusted book balance equal. That's exactly what should happen at the end of this bank reconciliation. So now that our bank reconciliation lines up, we're going to have to record journal entries to adjust our books to the balance that it should be at the end. On your bank rec, there is the bank side and the book side. Well, guess what? We don't control the bank's books, so we don't need to worry about making any journal entries for the bank portion of this. We're only concerned with the book portion of this. So only on the book side are we going to account for the discrepancies. Let's start with the adds. We had an EFT receipt and we had a bank collection. Well, first we have to know what they're for. So let's assume that the EFT receipt is for rent paid to us. I mean, we were renting out a storage facility to another company. So when we record that, they're paying us, which means our cash has to be going up, and it's going to go up for 150, and we're going to credit whatever we got the cash for. In this case, we rented something out to someone, so we're going to record it under rent revenue for 150. In the bank collection, again, we're going to have to know what it's for. So let's say it's for a notes receivable, which means that we let someone else borrow money once upon a time, and when they paid us back, instead of sending us a check to our company, they wired it directly into our bank, and we didn't know about it. We haven't put it on the books yet. Let's do that right now. Again, we're getting the money, so we're going to debit cash. So we're going to debit cash for $1,200. What is our credit going to be? Well, it's a notes receivable. At some point, we had that note on our books saying someone owed us that money. They no longer owe us that money because they wired it directly to the bank, which means we need to take that receivable off the books since it's no longer outstanding. So we're going to credit notes receivable for $1,200. Those are the only two items that we had underneath the add section. And you'll notice that under the add section, both of the journal entries that we made for the bank rec had a debit to cash. 100% true. Every single discrepancy that you're accounting for under the add section, the journal entry to fix it is always going to be a debit to cash because your cash account is going to be going up. For everything under the less section, your credit's going to be to cash because it's decreasing your cash balance. Well, let's go through and let's sort out all of the different things that we have on here, starting with our NSF check. So how are we going to recognize an NSF check? At some point, someone wrote us a check, and it was to pay off a receivable that they owed us, and we assumed that it was good, so we put the cash on our books, and we got rid of their receivable. Well, guess what? Check was no good, which means they still owe us money, which means we have to go through and put that receivable back on the books. So we're going to debit accounts receivable for $900, and we're going to credit cash for $900 because we never actually got that $900. We recorded our NSF check. Three more items to take care of. EFT payments. Again, we got to know what it's for. In this case, let's say it's for insurance. So we auto wire our insurance payment to our insurance company, and it didn't get recorded on the books when that auto transfer went out. Well, we're going to record it right now, which means this is going to be a debit to insured's expense for the amount that we are paying for, which is $840, and it's going to be a credit to cash for the same amount. So we recorded our EFT insurance payment. Correction of book error on rent payments. So what happened here? If you will recall from earlier, we recorded a check for $690, which was apparently to pay our rent to somebody else, when the number should have actually been $960. So it was misrecorded for $270. Well, to fix that, since it should have been higher on our books, we have to increase the amount of rent expense that we recorded. And that is for the difference between what we originally recorded it for and what it was supposed to be. And because it's under the less section on a bank rec, it's also going to get credited. Corrected book error for rent payment. And lastly, we have the service charge. It's $25 coming out of our account to send to the bank for all the lovely convenience that the bank provides us. And we're going to record that under bank expense. So I have seen on books before where people have service charge expense, check printing expense, etc., like a different account for every service the bank provides. I ain't that person. I record all that stuff underneath just one account, which is bank expense, which is what's happening here to ABC Company, and it is for $25. Again, decreasing our cash because they're taking the money out of our account to pay our monthly charge. And we recorded our monthly bank service charge. Good luck on your quiz, everybody.